Welcome to the Optimize Monthly Snapshot. I'm David Ferreira, Portfolio Manager with Optimize Wealth Management, and for this snapshot, we'll update you on the moves in the markets over the past month, provide some highlights from our portfolios, and touch on some of the opportunities we see on the horizon. July was another great month for value stocks as investor buying broadened beyond growth stocks and big tech. For example, the Dow led US markets with a 4.3% gain, and the TSX was up 5.3% for the month. The S&P 500 advanced by 86 basis points while the Nasdaq eased 2.3%. All asset classes moved higher in July, with strength really coming from cyclical and value-oriented stocks, which offset underperformance from more growth-focused names. Moving US markets in July was economic data that showed consumer inflation continued to cool to its lowest level in more than 3 years. And US retail sales for the month also came in better than expected, showing the resilience of the US consumer. In Canada, consumer inflation also eased further in June, resulting in a BOC rate cut, while the labor market saw slower growth, which points to more interest rate cuts from the Bank of Canada ahead. Now let's take a closer look at our portfolio highlights for July. We continue to see opportunities in value stocks, which have benefited from the global interest rate cutting trend this year. Value-oriented sectors have performed very well in July, with the real estate sector up 8.2%, utilities up 7.5%, and financials up 6.1%. We first highlighted the potential for market broadening back in May, which emphasized our diversified approach to sector selection. Bonds have also performed very well in our portfolios, particularly long-duration, high-quality government bonds. The iShares Core Canadian Government Bond Index, for example, returned 5% in July. This asset class has demonstrated its effectiveness as a hedge, especially now with interest rates at relatively high levels. Due to the negative relationship between bond prices and yields, with interest rate cuts on the horizon, this should increase the price of long-duration bonds as the rate cutting cycle continues. We have had consistently emphasized the importance of diversifying not just across sectors, but also across asset classes. Our income-oriented portfolios have benefited from meaningful bond exposure. In addition to serving as a hedge, bonds also generate income that can be reinvested into other asset classes at attractive prices during times of market volatility. As such, we continue to manage our dynamic asset allocation to build stable portfolios and take advantage of market opportunities as they come. Turning to our position spotlight this month, I wanted to touch on Manulife Financial. The insurance and financial service giant stock prices climbed more than 18% year to date and over 33% over the last 52 weeks, outperforming the TSX's 11% gain over the last year. Manulife's first quarter results beat analyst expectations and showed 20% year-over-year improvements in earnings per share, boosted by double-digit growth across each of its insurance segments. Looking closer at some of Manulife's divisions, while the company's life insurance business has remained a cornerstone of its revenue, the global wealth and asset management division has emerged in recent years as a key driver for growth. This part of its business saw $6.7 billion of net inflows into its group retirement, retail wealth management, and institutional businesses, with assets under management climbing 9% year over year to $880 billion. Manulife has also strategically expanded its presence in Asia, capitalizing on demographic shifts and economic growth in key markets. While the company's Canadian operation and its US John Hancock subsidiary remain the core of the company's earnings, Manulife has a strong track record of investing globally. Manulife's Asian division recorded a robust 39% year-over-year growth in core earnings to $488 million USD. With Manulife's solid financial footing, increasing stock buyback program, and further expected dividend increases, we remain optimistic about the company's growth prospects and expect it to remain a core holding in our portfolio for the foreseeable future. Finally, we take a look at investment opportunities ahead. One trend we've been keeping an eye on is equity investment opportunities on further interest rate cuts from global central banks this year. We're closely watching the US Federal Reserve in particular for its first rate cut reduction, which could happen as soon as September. Recent economic data has shown that the rate of inflation easing in the US while US consumers remain resilient and the unemployment rate has remained stable. All of this has increased the odds of Federal Reserve guiding the economy in for a so-called soft landing. In Canada, the country's central bank has already cut interest rates by 25 basis points for 2 consecutive meetings, as recent domestic economic data has shown the Bank of Canada seems to be winning in its fight against inflation. We believe this lower interest rate environment will boost global growth, which bodes well for stocks over the long term. And that's all for today's monthly market snapshot. It was an exciting month with some positive momentum heading into August. Thank you for tuning in and see you next month.